Now, most investments don't fail because the idea was wrong. They fail because they didn't survive long enough. Over the last 20-25 years, markets went through the dot-com crash, the global financial crisis, COVID, and rate shocks. Thousands of stocks came and went. Entire industries disappeared. Yet, a small set of ETFs did one thing consistently. They stayed relevant. They adapted and they compounded. Now, some of these ETFs benefited from the steady expansion of the US technology system. As American tech companies scaled globally, dominated platforms, and became the default infrastructure for businesses and consumers worldwide, broad tech ETFs compounded alongside that adoption. Others captured more recent inflection points. Semiconductors, AI-driven computing, and advanced manufacturing themes scaled rapidly as data, automation, and intelligence became central to economic growth. Today, we are looking at 7 ETFs that didn't just perform well, they stood the ground across the generations of markets. So basically, here we're talking about the top performing ETFs of the last 25 years, or basically the 21st century. ETF 1, IGM. iShares Expanded Tech Sector ETF. If there is one ETF that explains why broad exposure beats perfect stock picking, it's IGM. Launched in 2001, right after the aftermath of the dot-com bust, IGM didn't start in a bull market. It started when technology was written off. And that is precisely why its long-term story matters. Over the last 20 to 25 years, IGM compounded at roughly 12 to 15% CAGR, turning early skepticism into disciplined wealth creation. What makes IGM different is its definition of technology. It doesn't restrict itself to traditional IT companies, it expands into internet platforms, digital commerce, and communication-driven businesses. Now, that is why names like Microsoft, Apple, Nvidia sit alongside companies such as Alphabet and Meta. Not trends, but the infrastructure of the digital economy. IGM didn't avoid crashes. It lived through 2008, corrected hard during the 2022's rate shock, and still came back stronger. And if you see, that is the point. The ETF wasn't built to predict the next winner. It was built to own the ecosystem that keeps producing winners. From a beginner investor, IGM represents a simple idea. You don't need to know which tech company will dominate the next decade. If technology itself keeps expanding, this ETF keeps compounding. From broad exposure, we move to a sharper, more focused version of US technology leadership, which is our ETF2, IYW, iShares US Technology ETF. Now, IGM works because it spreads exposure wide. IYW works because it doesn't. This ETF is built on simple but uncomfortable idea. In technology, a small number of companies end up capturing a disproportionate share of value. Network effects, scale, capital, and distribution don't spread evenly. They concentrate. And IYW is designed to lean into that reality. Instead of expanding into adjacent sectors, IYW stays slightly focused on core US technology companies. Software, hardware, semiconductors, and IT services. No dilution. No narrative of diversification. The result is a portfolio where a handful of companies do most of the heavy lifting. And historically, that is exactly how tech wealth has been created. Over the last 2 decades, this structure translated into 15% CAGR compounding, despite long flat periods and sharp corrections. And returns didn't come from constant momentum. They came from letting a few dominant businesses grow into giants while the index quietly rebalanced around them. Now, IYW is not trying to capture every innovation. It is trying to stay invested in the companies that turn innovation into durable cash flows at scale. For investors who believe that tech leadership keeps reinforcing itself, this ETF shows how concentration, when applied patiently, can work in your favor. Next, as we move to a fund that takes a similar tech bet but optimizes for cost and breadth instead of concentration. ETF 3, VGT, Vanguard Information Technology ETF. Now, VGT answers a very different question. What if you wanted US technology exposure but with process over prediction? This ETF isn't designed to chase momentum or concentrate aggressively. It is rather designed the Vanguard way. Low cost, broad coverage, and rules-based discipline. VGT tracks the entire US information technology sector across large, mid, and even smaller companies. That means today's giants sit alongside tomorrow's contenders, all inside one structure. For the last 2 decades, this approach has delivered a consistent 14.7% CAGR, not by timing cycles, but by letting the sector evolve naturally. Companies entered, scaled, and sometimes even faded. The index didn't panic. It rebalanced. That is why VGT looks boring on paper but powerful over time. One underrated advantage, although, here is the cost. With an expense ratio close to zero by global standard, VGT keeps more returns in the investor's pocket. Over 20 years, that difference quietly compounds into a meaningful edge. No drama, no churn, just efficiency doing its job. Now, from broad technology, we now narrow the lens to the component that powers everything else. ETF 4, SOXX. iShares Semiconductor ETF. If technology is the visible layer, semiconductors are the invisible dependency. SOXX doesn't invest in apps, platforms, or software stories. It invests in the companies that make everything run underneath. Chips that power phones, data centers, cars, factories, networks, and now even AI models. When demand for computation rises, semiconductors feel it first. This ETF is narrower by design, and that comes with higher volatility. Semiconductor cycles are real, inventory gluts happen, demand slows, and stocks correct hard. Now, XOXS has been all of that. But that over a 20-year window, those cycles mattered far less than the structural truth. The world keeps needing more and more computing power. That is why this particular ETF ended up delivering 14.6% CAGR from the last 20 years, despite periods where returns looked uncomfortable in the short run. The ETF didn't rely on a single company either. It spread exposure across chip designers, manufacturers, and equipment suppliers, each benefiting from different parts of the same growth engine. For investors, this ETF represents a more focused bet than broad tech. You're accepting sharper drawdown in exchange for owning a sector that sits at the center of every major technological shift. Smartphones, cloud, electric vehicles, AI, none of them scale without chips. Next, we look at a semiconductor ETF that takes a very different approach to capturing the same opportunity. ETF number 5, PSI, Invesco Dynamic Semiconductors ETF. SOXX represents the mainstream semiconductor story, but PSI takes the side streets. This ETF isn't built around market cap dominance. It follows a rules-based and a smart beta model that deliberately avoids letting the biggest chip companies overpower the portfolio. Instead, it spreads weight more evenly across manufacturers, designers, and equipment makers, many of which sit in the mid-cap space. Now, why does that matter? Because in semiconductors, the strongest growth phases come from companies before they become giants. New fabrication technologies, specialized chips, manufacturing tools, these businesses often scale quietly and then suddenly re-rate when the demand inflects. PSI is structured to capture that phase early. Over the long run, this approach paid off. Despite being less talked about, PSI delivered a strong 14.55% CAGR over nearly 2 decades, at times even outperforming the traditional semiconductor ETFs during expansion cycles. The trade-off is higher volatility and less predictability year to year. This is not a smooth ride, but PSI works best for investors who already understand the semiconductor theme and want exposure beyond the obvious names. It is less about betting on today's leaders and more about letting the next layer of winners emerge inside the portfolio. After semiconductors, we move back to the large cap technology, but with a very different construction philosophy. ETF number 6, XLK, Technology Select Sector SPDR Fund. XLK is what happens when technology matters. This ETF represents the technology slice of the S&P 500, and that immediately changes its behavior. You're not buying emerging disruptors or mid-cap innovations here. You're owning established cash-generating giants, companies that already dominate their categories and move the index by sheer scale. Over the last 20 years, XLK compounded at roughly 15 to 16% CAGR, despite carrying the baggage of the dot-com era in its early history. If you zoom out further, its full 25-year existence returns look more modest at around 9 to 10% CAGR, largely because the 2000 crash was brutal and recovery took time. That contrast itself is the lesson. What changed post 2010 was profitability. Apple and Microsoft didn't just grow revenue, they turned into cash machines. As those two companies grew to represent a massive share of this ETF, XLK's performance profile shifted from being speculative tech to earnings-driven compounding. For investors, XLK works as a stabilizer within technology exposure, lower innovation risk, lower surprise factor, but still strong long-term returns driven by companies that have proven that they can survive, adapt, and dominate across cycles. Finally, we come to the ETF that many investors already recognize, even if they don't realize it yet. ETF 7, QQQ, Invesco QQQ Trust. Now, this is the ETF that shows what happens when innovation keeps replacing itself. Launched in 1999, Triple Q had one of the worst possible starts. After the dot-com bubble burst, it lost more than 70% of its value in the early 2000s. Many investors exited permanently. Those who stayed learned the core lesson of this ETF that Triple Q doesn't avoid disruption, it absorbs it. For the last 20 years, Triple Q compounded at roughly 14.56% CAGR, showing how destructive early exits can be and how powerful long-term participation becomes once the index refreshes itself. Triple Q tracks the Nasdaq 100, which means it continuously replaces declining companies with emerging leaders. Old tech exited, new tech entered. Apple replaced Cisco, Amazon replaced Yahoo, Nvidia replaced legacy hardware names. The index didn't predict winners, it updated itself. Today, Triple Q represents the front edge of the global economy. Cloud, AI, digital platforms, electric mobility, and consumer technology all sit inside one structure. It is volatile. It corrects hard, but historically it also recovers faster than most broad markets because innovation doesn't pause for long. For investors, Triple Q is not about safety, it's about staying aligned with the economic value that keeps migrating. Over time, that alignment has been extremely rewarding. Seen together, these 7 ETFs are not about finding the best one, they are about avoiding the wrong ones. Each fund represents a different way capital aligned itself with long-term global trends. Some captured scale, some captured leadership, some captured depth within a single industry, different constructions, different volatility profiles, but all anchored to businesses that remained economically relevant while markets evolved around them. For an Indian investor, this is the real takeaway. You don't need to understand every sector, every stock, or every global cycle. You need exposure structures that adjust as the world changes, and ETFs do that by design. Now, global investing isn't about predicting which country or sector will win next. It's about ensuring your portfolio isn't structurally excluded from where growth actually happens. Now, if you're looking for more such valuable information around global ETFs, then Appreciate is that place. Do subscribe to the channel and we'll keep bringing more such videos soon.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.